All
Yeah,
right.
so welcome back everyone to the third episode of Crypto and Coffee podcast. My name is Giordano. I'm one of the co-hosts here. Then we have Cordell Tanny and David Blackstone with me. If you guys want to introduce yourself to the audience, that'd be great.
Sure.
David, man, you're first this week.
I'm David Blackstone. I set up a stablecoin company within crypto, as well as a couple of extra offerings that will be coming out soon. And this is one where we provide multi-currency stablecoins for all systems. So this is one where, for the topic today, I am rather well researched. So I'm looking forward to it. I will add though, I did pick this up. I did pick up a. Now
You
you
go
can't see
closer to
it
the camera. I can't see what it is.
Yeah, there we go. I picked up a small travel system for a microphone, but I haven't tested it out yet. You can see I haven't even pulled it out of the
Yeah.
box. So I'm sorry about that. I'll have it ready for next time.
It's all good. They tend to work really well. So. All right. Hi, everyone. My name is Cordell Tanny. I am a 25-year veteran of the financial services industry, primarily as a portfolio manager, as a quantitative portfolio manager. I am currently the co-founder of Vault 42, where we do algorithmic trading for various cryptocurrency strategies. And we run things, we're trying to be one of the first active managers of cryptocurrencies where everything is on chain, everything we do is verifiable. And that's where we are today. All right, Gio, your turn.
Yeah, sounds good. My name is Giordano Burstamaris. I'm currently the CEO and one of the many co-founders of Etc. So Etc is basically a digital asset platform that is changing the way people trade, giving people a lot more customization in the market that will give you a lot more opportunities trading. So you can customize your dashboard, your interface, as well as the charts indicators. You can do things like oops, sorry, lost my train of thought. But you can do things like have multiple order types. Yeah, so we're trying to change the way that people trade essentially. So on today's episode 3, we're going to be talking about some main points. For instance, we can start off with what is a stable coin, and then we can get into the PayPal USD incident, as well as BRICS, as well as CBDs. So, David, you being the owner of a stablecoin blockchain or stablecoin startup, can you just explain to, like, let's say the average listener, someone who's just tuning in, explain to them like their 5-year, what is a stablecoin?
Sure. And I'm going to paste a link into the chat for this. This is something that we have on our site, going over the stablecoin trilemma. And this is something that is inherent to all stablecoins. You have to make a choice, much like the cryptocurrency trilemma. There is one for stablecoins specifically within that area. Now, stablecoins at their base, it's just a stable coin. So you have a coin that is pegged to a stable price instead of a speculative price. Bitcoin is a speculative price. Stocks are a speculative price. Stable coins are coins that remain stable against some asset. Now, a lot of people are seeing them as USD. It's not just US dollars. Stable coins can be gold stable coins. They can be Chinese yuan stable coins. They could be stable coins tied to your house or stocks. As long as the price remains stable compared to some asset, then that is a stable coin. So if I had let's say a quarter stablecoin pegged to the US quarter, that is just as valid a stablecoin as the US dollar one. But people see mostly US dollar stablecoins, so it has generally taken on the connotation of being a virtual US dollar. If you dive into it though, all of these have trade-offs. You've had stablecoins that came about before Tether, before Circle, and all as well as after. You have DAI, which is a decentralized stablecoin. You have the one from Orchestra Labs, which is a decentralized stablecoin. You have the ones from Circle, Tether, Athena, and all of these have different approaches, which is where that trilemma comes in. Because for every single one of these, you have to pick between capital efficiency, decentralization, or price stability. That's why there's that little triangle there for that trilemma. If you have capital efficiency, you can buy in 1-to-1 again with the asset or at a ratio of value to that asset to buy 1 unit of that stablecoin, which has the same value as 1 unit of that asset. If you pay more than that, it is not capital efficient. If you are tied in some way to a centralized entity, then it's not decentralized. If this is tied to the U.S. government, it's not decentralized. If it's tied to a single organization, if that organization has control over the stablecoin in some manner, it's not decentralized. And price stability. This is where the Terra fiasco came in. A lot of algorithmic stablecoins, they did not look at anything at negative pressures. So what ended up happening, as in the case of Terra, the most famous example and very good test case for this, if you don't figure out what's going to happen in negative scenarios, negative price scenarios, what's going to end up happening is your price is not going to be stable. It's going to fall off the dollar. And this isn't just for algo stables, it's for others as well. When Circle fell from Silicon Valley Bank, when Silicon Valley Bank went under, Circle fell off of peg, and it happened in every single exchange that they were listed on. They fell to 80 cents. People did not believe that Circle could fulfill all orders at that point. They would have essentially had a bank run if everyone could have had access to this. So that shows price stability isn't only a thing for decentralized stablecoins, but it is something where centralized ones do have it a little bit easier, because within that trilemma, they are closer to the point on the triangle. So you have a triangle. They're closer to that point of capital efficiency and decentralization than to price stability. So like they don't have to make that trade-off. Well, they're closer to the point of capital efficiency and price stability than decentralization. They're trading away decentralization as a trade-off to get closer have more control over capital efficiency and price stability. That's what I meant. Sorry.
So what you're saying then, really, I mean, because if we think about in terms of stable coins and making sure people understand what makes them stable and how they function, you've described one method of how they can function, which is really the algorithmic method, where an algorithm is going to be trying to peg it to the other one and then do a kind of creation destruction kind of thing of like the sister one. You create 2 coins, one's a sister of the other, and you maintain the peg by doing it this way. So those are the ones driven by algorithms. So the risk that we saw with the algorithmic ones is that the algorithm didn't necessarily account for every single possible scenario, especially if something happens to one of those pairs that the algorithm's trying to balance all the time, and then one runs away and it can't do enough with the other. That's what essentially happened with Circle, with USDC, right? That's what I understood. So, and then you're also comparing, let's say, centralized to decentralized. So when we talk about a stable coin that would actually be backed by fiat, right? So if we think of the other ways that you can create a stable coin, so where, let's say I'm issuing a stable coin, I could keep $1 US in the bank for every 1 unit of my stable coin that I issue. So I keep this 1-to-1 fully backed by my bank reserves. So I guess my question is, do you consider that one to be a centralized one? Where does that fit in? And then if we think about the other one where I could use other cryptocurrencies as collateral for, let's say, my stable coin. So you got 3 ways to create a stable coin. Algorithmically, one actually put currency in a bank to act as the reserve to back it, or use cryptocurrencies as collateral to back it. So from your experience, David, where do you see the risks? Which ones of those are centralized? Like, what is your preference? Like, what can you tell us about the 3 different methods of creating a stable coin and what people should know about that?
Well, any of them can be centralized, but the ones where you're putting money in a bank are generally going to be more likely to be centralized. So, like as you said, you have the algorithmic ones, you have got the crypto-backed ones, and you've got the centralized ones. They are generally categorized as decentralized ones. If you have a stablecoin where you put money in the bank, then you are tied to that banking system, which is a singular system. If things happen, like for example, if you have a Venezuelan Bolivar stablecoin and Venezuela crashes the same way that it did, hyperinflation and everything, you're going to have problems. And there are additional problems there that don't go accounted for, because Circle and Tether, they don't have, like, even though they propose legislation to back everything by government bonds, essentially make you buy the government's bags. If they don't have everything as 1-to-1 on cash, they don't have everything as 2-to-1 on cash, and they show and they advertise as having a 2-to-1 backing. What they have is a portion of that in cash, and they have the rest in bonds. So I categorize that as not holding cash, but as holding a promise of future cash, like a promise of future collateral. So the problem with bonds is that when you have things like hyperinflation, like what happened with Venezuela, the exact example that I just called to, you have bonds crash faster than the money, because if your money is losing value this quickly, and your bonds are promising you, if your money is losing value this quickly at, like, let's say 100%, which is minimum definition of hyperinflation, and the bond promised you 10%, the bond is absolutely worthless. No one is going to want that bond, so the value of the bond is going to crash faster than the value of the currency. And that's happened very literally in cases of hyperinflation. Now, if they hold bonds, they're not holding cash, then they're not exactly holding 1-to-1 on dollars to dollar stablecoins. They're holding a promise of future capital against stablecoins, against their stablecoins, which a lot of people miss that. Now, there is a centralized. I do still think that they're centralized, even if you exclude the banking system, though, because if the U.S. government, and this is why BRICS became such a big thing, if the U.S. government says you don't get to trade anymore, you don't get to use the U.S. dollar anymore, these companies have to exclude you from that. This is why when Russian decentralized exchange got access to USDT, people from USDT on Twitter started saying, "Oh, they shouldn't have this. Let's look into how they got this." Because and you see articles all the time where USDC and USDT blacklist people and prevent them from holding those coins. They are centralized coins. They have complete control over who gets them. Well, maybe not complete control, but neither does the dollar. You hold cash, you're good to go. Russia still had access to U.S. dollars, even though they got sanctioned and had all their assets seized. They moved off of it. BRICS moved off of it, but you can't control everything, even when you're centralized. They are centralized. They are able to blacklist you. They are able to keep you from trading. They are pretty centralized. But that doesn't exclude algorithmic ones. It doesn't exclude crypto-backed ones, because they can do the same thing just through their organization level instead of a government level.
Yeah, one thing I wanted to ask you, David, what is the regulatory implications on a stablecoin versus like a regular token or cryptocurrency?
Well, every government at this point, they're all basically pushing the same thing. You have to hold our bonds in order to print the stablecoins. Now, the reason why I don't like this is because the government can make it whatever decision they want to, and they can say who can hold their bonds, who can't, who can hold their currency, and who can't. And that's entirely against the whole ethos of crypto for when it was made. Crypto was supposed to get off the banking system. Crypto was supposed to prevent bigwigs from being able to control your money and what's going to happen with it, from being able to lose value in your money, from being bailed out and all this stuff. There were a lot of problems with the financial system, and crypto was supposed to move away from that, like have additional accountability because you had records. Now, moving towards that financial system and doing everything the same way that it was done before, I don't think that follows the ethos of crypto. With that, you have all these bond systems, and it's basically government saying, buy our bags. You have the U.S. government printing more money every single year, and it's going to pop the next time there's a crash, because do you think they're going to let the stock market crash? They didn't the last few times. So what's going to end up happening is they're going to inflate the currency, and it's going to be at a much higher level than they did the previous times, because every single time they do it, they have to do quantitative easing more than the last time. So those bonds are going to lose value, and the currency is going to lose value. And if you hold within a stable coin, you're going to be losing value at the same rate as the native currency. Sure, it's not as speculative as some cryptos, but you're still losing value. if you're only holding the US dollar to try to escape, if you got into crypto to escape the loss of value in the US dollar, and then you go back into the US dollar stablecoins, it kind of came full circle. But with that, I just don't like them because they have so much control and all this stuff. But I think I lost the original end goal of the question.
Yes, so I was asking you about like, what other regulatory like implications of like a stable coin versus like a regular cryptocurrency or token, right? So you know how like stable coins are necessarily like pegged to let's say Chinese yen or even US dollar, right? Compared to like a cryptocurrency like let's say Bitcoin or Ethereum.
Yeah, that was it. Before I went on to the rant about the government.
How you hate the bigwigs. Yeah, we heard that part.
Yeah. So every country is pushing the same regulations. You buy our bonds, then you can print the stable coins. So essentially turning the stablecoin companies into banks. Now you have the US government printing money, like I said. One thing that they did with banks is that they forced banks to hold a certain amount of assets within safe assets. Those safe assets meaning their bonds. So banks have to buy their bags. Banks in order to print money have to buy the debt. Now with that, you're going to have stablecoin companies doing the same thing. You buy the debt, you can then print the money. So with these, it's going to be doing the same thing as banks. It's just on the blockchain instead of with a brick and mortar. What you're doing there is you're creating a system where you have a layer of abstraction because people think like, okay, this is crypto. It's supposed to be free. It's supposed to be uncontained. But then they're doing the exact same thing. With regular cryptocurrencies, you don't have that. You don't have that system. You had this whole thing back and forth between the SEC. Are they assets? Are they currency? We're going to count them as assets. No, we're not. We're going to sue you. We're not going to sue this one. All this stuff. And like that was very literally a multi-year-long case with Ripple. At Ethereum. I think it was Gary Gensler who said that Ethereum was the only one that was going to be excluded, Ethereum and Bitcoin. But well, he's out now, so like that doesn't matter anymore. But we've got slightly different rules for crypto versus stablecoins, because stablecoins are now being seen essentially as cash or as a way to offload bonds. Some people think that the government is trying to offload debt towards the stablecoins. Some people think that it's another way of introducing CBDCs, but cryptos, well, some people think that like Bitcoin is a way of introducing a CBDC as well, but we don't have to get into that. But cryptos, they operate under separate rules. You don't have to hold bonds in order to create cryptos. You don't have to have some X backing based off of however much of the government bonds you bought to hold cryptos. But while on this, I will say I don't like how Circle pushed this regulation, because they essentially forced everyone to be on Circle's business model. Now this happens every time you do regulations. The established business pushes regulations to force everyone to be like them, because they don't have to pay anything else to be like them. They're already like them. Everyone else, every other startup, every other company has to pay money to be like the company that actually managed to bribe the politicians properly. I'm sorry, that managed to give them their donations. Like that managed to convince them properly monetarily. But
because it brings up a lot of other questions, just based on that, right? Because you're even focused right now just on, let's say, Circle or even Tether. You have two companies that, let's say, are setting the rules that everybody else is going to have to play by now, right? Now, if we, pardon?
Yeah, just one. Circle won. Circle won because they outbid Tether on the I don't remember what the actual name for them is, so I'm just going to call it bribery. They outbribed Tether. So all the companies had to align to Circle's model. So Tether had to create another stable coin to reintroduce to the U.S. market, one that was under the model that was like Circle. Circle won on that. Like they managed to outbid. They managed to outbid the government compared to Tether.
Okay, so now we can take that one step further, right? Because now that we have Clarity Act, we have Genius, we've got a lot more clarity around what's going on with stablecoins. So now that we have this, that we have Circle, which is essentially now setting the rules for the
Yeah.
stablecoin industry, let's say. Now we're going to talk about, let's say, PayPal coming out with PayPal USD, or we start talking about any other company that all of a sudden will want to launch their own stablecoin. And look, the reasons why these companies will want to launch their stablecoins, their own stablecoins, is I think pretty apparent, pretty obvious, right? I mean, no one wants to keep paying MasterCard and Visa the transaction costs, the crazy costs that they charge. So when you start thinking about how PayPal USD, if this thing starts coming out, and then if Amazon launches one, if Walmart start, this is going to start a chain reaction really throughout not just what they're doing, but all of the verticals, everyone, like all of the infrastructure that needs to support that. How the end user, the retail person buying, like my mother is not going to get a wallet, a crypto wallet, and start buying at Walmart with it. Then we have to start protecting people. We're going to need the cybersecurity. So this is going to start a whole snowball. So what I'm trying to get to here is, based with what you just said, with Circle now setting the rules, how does this affect every other company that wants to start issuing a stable coin? How do you see that unfolding? And then we could really jump more into the risks and what can go wrong.
Well, the U.S. government is going to like it because that's what they want. They lost large demand sources from China and Japan. China does not want U.S. bonds anymore, and that's specifically because the U.S. pressured Russia with their sanctions, and China knew that they were next. You've got Japan dumping those because Japan is in a severe economic strait right now, and they have to do that in order to prop up the yen. So with the two largest buyers by far dropping demand, they had to create another demand source. This ended up being stablecoin providers, because stablecoin providers that had to align to Circle's model were then forced to buy bonds that created a new demand source for U.S. bonds. So they have another outlet for their bonds, essentially a way for people to buy their bags. Something I keep mentioning. This is a very popular crypto term. Everyone in crypto should know what I'm talking about on that. Like, essentially, if they think they're going to be losing value and you buy into that, they're no longer losing value because they're selling at this level as opposed to this level. So with those companies, though, from the other side, from the retail side, as more companies get in, as more companies make their own stable coins, if they all make it on the same blockchain, sure, you're still going to have issues with trade between them. But if they all make it on the same blockchain, that solves the decentralization problem, because one company having their own blockchain makes no sense. A blockchain is not efficient. It's like if relating blockchain to a ledger, because it's a ledger. If you have 20 guys all writing the same thing in different books, and they all have to go over to each other, hey, what did you write? What did you write? Like, no, I think it should be this. That's not a very efficient way to do it, but that's how blockchain works. And so if you have all of that happening within one company, why are they doing that? They could have it go by a database instead, have it be much faster, and serve 100,000 or millions of transactions per second instead of the 10,000 that you're going to get on the blockchain. So there's no point in any of them having their own blockchain. But if they all go on the same one, sure. What you're still going to have, though, is you're going to have problems with trading between Walmart dollar versus Amazon dollar versus AT&T dollar. And so essentially, it's like everyone giving their own gift card, and none of those gift cards work together. This is why Visa existed before, because Visa worked as a payment system between all these different companies, and they would all accept it. Instead of you buying a Walmart gift card and then going over to AT&T and saying, I'd like to buy a phone. They would not accept that. They're creating that same system in the same way that we got off of cable and went over to streaming, and then everyone wanted their own streaming service, and now we've got cable again. Yeah, they're doing that. If they continue down this route, we're going to end up in the same place with another layer of technology that complicates things more, and then we're going to have to build out the same solution that we did in the first place, that we were trying to build in the first place. So we have all these stable coins. Like, we have 100,000 stable coins. Let's say 100,000. Just to throw a number out there. And now we need an interconnecting system. That way, everyone can trade with each other, which is the exact thing that we needed in the first place.
Yeah, because otherwise, you're just stuck with that one company, right? It's essentially become a massive loyalty program.
Yeah.
All right. So, wow. I mean, I'm also just thinking about you know, when I was thinking about really if Amazon starts, you know, like just what would be required for an individual or, you know, to get this being adopted at the individual level, right? I mean, and the amount of companies, the amount of industries that would see complete boom, whether these are entirely new industries. Like imagine if this became pervasive and not just that, I guess Visa and MasterCard would probably be the ones to fill the gap to figure out how to do all the swaps between all the different currencies, considering that's what they're there for anyway. And there's no way they're going to let anyone mess with their business model. They are going to have to adapt. You would think the credit card companies are going to be one of the first ones that are going to realize the danger of this and try and jump into it. So let's think a little bit about what the future would look like, you know, in terms of the industries that would be booming and what new industries are required if we do start having mass stable coins popping up everywhere. So just think about what this future would look like. Think about the companies that don't exist or the ones that we would need to create to be able to scale this out to the retail level. I mean, that's the future if this keeps going like this, right? So how would you see that working?
Well, I tried to get funding for this 3 years ago, and that didn't work out. And I'm still building it anyway. It's just taking a lot longer because I'm having to fund it all or build it all myself, and that's basically free time and available and free capital for that. So it's taking a little bit longer, especially since I wasted a year. Like, all right, so everyone believes that when you try to raise money, like we've gone over this in a previous episode, so keep it short. Everyone believes that when you try to raise money, if you have a good idea, that's what it takes. Like you have a good idea, people will fund the good idea, and then you can build from there. No, you build it first, you get the customers, then you go to them, because otherwise they'll take your idea, they'll go to their portfolio companies, and they'll have their portfolio companies do it. And then you'll be just out, like you'll be outdoors with nothing for your name with that. It's like, don't do it that way. Build it first. So in this case, what I've been trying to build was a stablecoin chain, multi-currency stablecoin chain, and people are just starting to figure out, oh, well, maybe we can do this with more than just the US dollar, and so they're going to start branching out on that. What we have with that is a system for automated exchange between all of these. Now, you have crypto exchanges, you have centralized exchanges, you have decentralized exchanges. Geo has its own exchange with etc. Now,
Exactly.
what you have with these is a way to connect multiple cryptos together, but the exchange needs a bit of money themselves for that. Now, if you have an automated exchange, you can do that automatically, and then you can have people just route through that. In our case, we don't take any swaps on exchanges between stablecoins, because for internal and external stablecoins, we want the activity, not the we want the activity which promotes the coin price. We don't have anything for the underlying exchange itself, because that is essentially a loss leader. Like in the same way that a lot of stores have loss leaders, that's our loss leader essentially. Now, if you have 100,000 stablecoins, in order to have Walmart dollar work with AT&T dollar, you're going to have an exchange, and no one wants to pay $1.20 in order to spend $1. So like that's a big problem with sending money overseas, or with credit card fees. You're essentially going to be paying more to pay for the same amount. You're going to be paying $1.20 to spend $1. Now, with that, you're not going to just need exchanges. You're also going to need automatic routing systems, because as people put stablecoins on different chains, you're going to have systems where someone is over here on this chain, essentially in their own country. You're over there on your chain, essentially in your own country. You could be trying to do business with each other, just standing 10 feet away from each other, but because you're on different chains, you have to jump through hoop after hoop after hoop to get it up from here to there. And each one of those hoops is going to cost fees. If you have an automatic router, you just go one to the other. It's one button press, and then you're good to go. And both of these I have. I have the routing system up. I've got the exchange system up. I've got the chain I've got the chain supporting all these different stablecoins up. The wallet, though, I'm releasing later, because while it does have the automatic router, it's still on private because I want to work out all the kinks before fully releasing it. It does have an automatic routing system, though. Because like that is one thing I absolutely hate about crypto. Why do I have, when I'm trying to work with an application, why do I have to jump through 4 different bridges over across 5 different chains in order to access your application? A lot of developers think this is a good user experience because it works. Me, as the end user, I don't think it's a good experience because I have to do 5 different things. If I interact with something, I want to press one button to do that one thing and then not worry about it. So that's essentially what I created. which solves this stablecoin problem directly and solves it before other people are trying to solve it. Because what you're going to have is people trying to trade with Walmart dollar at AT&T, and they're going to have to cross from Solana over into Ethereum. They're going to have to cross from stablecoin one, which is now bridged and is now a wrapper, into the other one. And maybe the exchange supports it, maybe it doesn't. But if you have an automatic router, it handles all that for you. No complexity. You don't have to worry about it. It's now essentially just like you're working within a system with cash.
So now imagine this, because this is just giving me more and more ideas. Because think about now, you've got Geo with this, you've got Geo's exchange, you got Acetra's exchange, right? If you think about how more and more this is going to wind up working together, now you've got stable coins, and even if you did have, let's say, what I'm doing, the asset management, again, you're talking about, like you just described, 3 different services, all related to your money. At what point do you have a centralized wallet as a service that allows you to do all of this? Your wallet as a service, you want to go trade on an exchange, your wallet as a service gives you Etc. You want to have someone manage your money, it gives you into active management of your cryptos. Or you want to do your daily shopping, you need the stable coins. What will it take for us to get a unified wallet as a service that can combine all of this together, if that's where the future is going?
Well, I am trying to build out. I'm trying to build out various in-wallet services out to different servers, so that way we could do something like that. But that is something that would be way down the road, because that would require having integrations all over the place. So that way, excuse me. Now, that would require having integrations all over the place. So that way, essentially, people could use your wallet for any different application. You're going to have integrations into banking services. You're going to have integrations into on-off ramping, into payments, into crypto apps. And all of this stuff is going to have to come from either a single wallet or a system of interconnected wallets. In our case, I'm trying to build those out into different services, but this is something where where it's going to take a while, because you do have to build up the user base, you do have to build up the connections, and a lot of those connections are going to come from people wanting access to your users, or from having been paid essentially the equivalent of a car. So with that, it's a long way down the road, but it is something that can be done. You do need to make sure that you can access the different chains that are going to be used, because everyone wants to use their own chain. If you have Ethereum, a lot of people use Ethereum, a lot of people use Solana, a lot of companies put up their own chain or their own coin, and you have to have access to all of those. So it's a very complex problem, but it can be done. The only thing that I would try to stay away from is centralizing it. So I keep Orchestra Labs as a dev group separate from all the offerings, and this is specifically because, like, the dev group is not supposed to have control over them. Now, the Aria wallet, that one is one that is its own product. It does have the automatic routing system and everything like that, but it does have income sources to support the servers. But it's not one that I'm really trying to make money off of. Like, maybe it comes in, that would be nice, but it's one where I'm trying to get a user base, so that way I can build out other things that I want to build, like much like the chain itself. Now, I'm not trying to run nonprofits or anything, but like I'm trying to make these so that way I can make other things. So I'd like to avoid centralizing things, because then you just get like another problem, like the Visa problem. And you've had Visa running around trying to tell people you can sell this, you can't sell that. Like, you've had this problem with Steam just recently. Visa said you can't sell these certain games. We don't like these games in your store, so you can't sell them. We're not going to give you payments for those. So Steam had to delist them. You get a centralized wallet, you're going to have the same problem, which is one thing I'd like to avoid, which is why I kept the chain as a decentralized focus, and I'm keeping the wallet as a decentralized focus. Our servers go down, the wallet is built so that way it can do all those things without the servers. It's just a lot faster with the servers. So it can do everything on its own, regardless of whether Orchestra Labs is running, regardless of whether our servers are running. The wallet will keep working. It's faster with us.
It's crazy. No, if you think about it, I mean, yeah, it's a long way off, but remember in 2003, all right, 2003, people were saying, we're all on this quest to have this little magic box in our pocket that could browse the internet, take a phone call, take a picture, answer emails, text messages. Remember what like 2003 was like? These things were an out. And now you do have this centralized magic box in everyone's walking around with a supercomputer in your pocket. So, you know, when there's a will, there's a way. And, all it takes is one company to pretty much get this idea. How you keep it decentralized, that I don't know. That will be, if anything that we've seen, there's always going to try and be a government or somebody that's going to try and take control of the entire thing. And I don't know how that can be stopped. But anyways, it is fascinating. And I do think that gives a nice little glimpse to the future. What I think people will be looking for is just the unified blockchain service for everything that's coming out. And whether it's 10, 15 years, maybe 5 years, maybe it'll even look like something we can't even imagine. But maybe it'll be controlled by your blinking your eyelids. We're all going to have the Neuralink implants, and we can control our payments through our eyelids. We never know. Geoman, and do you have any questions? Like, I know that we had some other things we wanted to cover here as well. Oh,
Looks like
call.
You froze there for a second, man.
Oh, sorry. While we're on the topic of stablecoins, this company called Paxos, if I'm not sure if I'm saying that right, they're behind PayPal's stablecoin. Apparently, mid-October, I think it was the 15th or the 14th, they had a $300 trillion worth of tokens accidentally minted because of a technical glitch, right? And apparently it's...
Oh, I think he froze again there.
Really? Yeah, no one was really, yeah. So they had 20 minutes. It took them 20 minutes to fix it. All the extra tokens were burned, but no one was really affected. No real money was lost, right? So what I'm thinking, David, how could this thing be stopped? Because what I'm thinking is that you can have a mint threshold or even some kind of form of protocol to stop things like this. But what are your thoughts on this?
Yeah, that's why when it was when people were looking at the Genius Act, and you had these big names on Twitter going on about this stuff, talking about, hey, what do you think about the Genius Act? Is there anything that you'd change? Is there any way that you'd make it better? How so, if you would? And a couple of them argued with me on this because they were the thing that they didn't like about what I was saying was but if we do it your way, we're going to have to rewrite the whole thing. We don't want to rewrite the whole thing. We'd have to redo it. We'd have to redo it all. It's yes, that's the point. It's not good right now. You want to change it. But Genius Act essentially was making it so that way everyone had to be Circle. And Circle's model is not keeping everything. Is not keeping one-to-one dollars to stablecoins. It's we went over that earlier. It's not doing that at all. And what they have is essentially, and getting a little deeper into the tech here, what they have essentially is a bank account that's saying you have this much, and then they have that going over here to you can mint this much, and that's not directly tied. That if they have it by code, great. If they have it going through a person, then they're not going to tell you which. If they have it going through the person, then the person can fat finger the zero button, and in the same way that PayPal did, and just print off an extra few zeros. That's basically what happened with PayPal right there. Just someone looked around while they were and talked to their coworker while they were pressing the zero key, and then looked back and said, "Oh no, what did I do?" Maybe they had some intern doing it. I don't know, but
they call that the fat finger error, right? It's the fat finger error.
Yeah, this isn't an off by one error that you have in tech. This is someone that pressed the zero key an extra 4 times or something. So they're going to say it's a technical error. The technical error is the problem between the computer and the chair. So you can solve that problem, and we essentially solve that problem. The way that you solve it is not by seeing it's not by seeing what you get at the end as the goal. You don't have the dollar being the goal. You don't have the dollar being the input. You don't have the yen being the input. You don't have the ruble being the input. All of these are units of value. If you buy a banana, if you buy a bag of rice with the unit of value, the number of units of value don't matter. The amount, the actual amount that you're dealing with there is how much value do you need to spend on this bag of rice to get it. So you remove the thought of the value from the thought of the unit, and then you can deal with all of this just as exchange of value. This is how you deal with it as a ledger. because the ledger is supposed to be recording the movement of value, not the movement of certain units. So they care about a number of units of US dollars. What happens when they try to add yen to that? Now they're going to have additional technical issues. They're going to have additional problems. What happens when they add what happens when they add the Indian rupee to that? They're going to have the same thing. And this is the exact problem that's happening with BRICS. This is why for years BRICS has been saying, well, you have problems with diversity. We have so many countries that want to join. How do we get a currency in that we can trade between everyone for? That's because they're seeing it as the units, not as the value. When you see it as a value, you have this many dollars that go into this many yen, and that equates to the same value. Now it's just a math problem. Now for any exchange of currency, you remove this many from this currency, you add this many to this currency, because you exchange this many units for that many units, you've moved the same value. When you buy, and people have a problem with that, it's like, well, what's going to happen with the reserve? The reserve is the same. The reserve is the same every time. The problem with stablecoins was never the reserve. What we had with the reserve was a problem where you had a horse that people were trying to measure, and people are arguing about whether to measure with the centimeter side of the ruler or the inch side of the ruler. The problem is that the horse is running, not that you're trying to measure which side of the ruler to use. The problem is that the horse is running. Keep up with the horse or get it to stop. That's the problem with the reserve, not which side do you measure with. So how you measure, the units that you're measuring with don't matter. What matters is that you have the value measure there. So if you have a problem with this, you don't have person A stepping in to press the buttons and that solves the problem. That just adds human error, which is what happened here. What you do instead is you make sure that your algorithm is proper and will work for the worst possible scenarios. And that's what I proposed for the Genius Act. If you want to change it, you don't make it circle because circle has worked so far. You make it so that you make it open-ended, and you make it such that it states that for any given model, they are tested against the worst possible scenarios for their system. If it works under the worst possible scenarios, they're valid. Anything else, it is invalid. In Circle's case, they would have caught this if that was the regulation, because what they had was all their money in Silicon Valley Bank. When Silicon Valley Bank went under, what happened? They got delisted. Yeah. If Terra was under this, what would have happened? They would have had to test against a panic scenario and find out what happens to their algorithm. What happens to their algorithm in that case? And then they would have been fine because they would have caught the issue and they would have fixed it, assuming that they wanted to fix it, because he had Do Kwon literally saying, someone who pointed out the problem, he told that guy, shut up, you're poor. So like, maybe they didn't want to fix it. I don't know. So, but you have a system where you take in value, you export that much value, and you don't have a problem anymore. All of a sudden, the fat finger problem goes away.
Yeah. And seeing as how BRICS, like the whole premise of it is to move it from the US dollar, right? I think this right here would make it a good opportunity and give them a reason as to why they should. Right? Seeing as US has been like the reserve currency for many years now.
Yeah. Yeah, it's perfect. Okay. It's a perfect scenario for them, because all you have to do, like for example, with my system, I literally built it for BRICS. It is everything that BRICS was asking for. You have a system for self-custody. You have the ability to hold multiple currencies within that reserve at the same time, so that way you can diversify those reserves. Yeah. And they can't be seized. They can't be blacklisted. Like they asked for those three things, and they asked for this years ago. I built that. It's not difficult. Like as long as you see, as long as you look at the value and not the units, it's not difficult. It becomes a very, very simple problem in that scenario. Like a lot of logic problems are that way. You change how you look at the problem, and the problem becomes easier, or the problem becomes harder, depending on how you look at it. In this case, looking at it as just value, that made it much, much easier. With BRICS though, like this is a very simple solution for them. They have their own systems. So all they need is a way to interconnect the trade, because Saudi Arabia doesn't want to take India's rupee. China doesn't want to take external currencies. They want to hold everything in the yen. Russia has proposed working with the yen. They didn't want to take Indian rupees. They'd probably take the dinar or something. I don't know. But that excludes the other 50 countries at this point that have all joined BRICS. Like you have over half the world population and over half the world's oil production within this economic system right now. That's a lot of countries. That's going to be a lot of different currencies. If you have a system where you can easily add or remove currencies, or if you change currencies, you can add the new one, remove that one, like with the Bolivar, where they changed currencies because they're hyperinflation. You can then just plug it in, and as long as it's got that exchange system in place, you can change one for the other with anyone within that system very, very easily. You can change the yen for the Bolivar, you can change the Bolivar for the rupee, you can change the rupee for the dinar for the ruble, all of this, and at any time. And if someone drops out of BRICS, you remove that currency. Easy.
Then what's slowing? Like, why is this not being pursued more? I mean, I get it that a lot of people sitting around a table are going to find it very hard to agree to get it to make everyone happy, but it sounds like it's just right there for the taking. Yet, what's stopping them?
Yeah,
Well,
just to add to that, like you have to also fight the fact that most people are gonna want like power in this. For instance, you have Russia and China fighting for power over the entire thing. I know everyone can have like their own CBDCs, their native currencies or whatever, right? But when you interchange that for cross payments, just to use it across BRICS, who's going to get the most power out of it? Or like you have to find like that way to make it a little bit more decentralized.
With BRICS, you have to keep things decentralized. Now, China wanting people to use the yen, like, of course they're going to push for that. The others push back against that because, unlike the G7, the G7 is basically all the countries that were in the British Empire, just under a new name. Now, so like America, Canada, England, like Australia, British Empire. So like they have a common background. They can work together. They can all say, all right, we're going to follow this guy for a while, or we're going to follow that guy for a while. They can do that. Because they have a common background, they have a common culture, they have commonalities that tie them together. BRICS doesn't have that. India has nothing in common with Russia. Russia may have some things in common with China just because of geography. Like they've got a lot of people on the border right next to each other. There's a lot of interconnected families. Like none of those three have anything in common with the Brazil. So you have all these different groups with all their different strengths that are coming together, and every single one of them is going to want to stop the others from getting power over them. So it's a lot more like the US when the US got started, as opposed to the US where it is right now, or like the G7 or NATO. NATO is basically the United States, which you can see when anytime the US does something, NATO backs it. When other NATO members push something, the US can just veto it. It's basically just the United States and its vassals. BRICS is not supposed to be that. Now, the U.S. when it got started, each state was essentially its own group. It could do its own thing. They came together on trade and war, but they came together on trade specifically. BRICS is coming together on trade. They can make agreements with other groups as a group should they want to. They have a system for interconnected trade between them, and it's all essentially a way to stop them from being sanctioned, to stop their economies from being targeted as a means of economic war. It's a way to stop their reserves from being taken. It's a way to allow them to continue to trade, and this is and with that, it's essentially what the EU was proposed to be, not what they became. Now, you do have groups that will try to get power, and essentially, and the US, like they fell to groups that tried to gain power over time. This will happen, but how long it's going to take for that to happen, that really depends, because you have a lot of groups there that can all push back against things. They all push back against the US, and that worked out well. But like when I say that it started in the same way that the US did, that calls back to what the U.S. was and what it became. When the U.S. started, it was a bunch of different states that all came together, like a bunch of different countries, like states, like city-states, like with Greece. So they all came together for the purpose of trade, but they were all their own independent systems, which is why you had people that claimed loyalty to Virginia or to Georgia, not to the U.S., but to their state, and they went where their state went. Using the Civil War as an example, they went with their state. So what happened to the U.S.? Well, over time, it became you had power move to the federal government more and more over time, until eventually people started ignoring what happened in their state and started saying started pushing everything to happen at the federal level. It can happen over time, and it happened with the European Union as well. But with where BRICS is right now, they need a decentralized solution, and a decentralized solution is stronger than a centralized one, because you have to attack multiple points in order to take it down. It's much better for them, in my opinion, and it's definitely possible. Like, we proved it.
So let's
Yeah.
take a look, for example, because we're talking about a group of countries that need some sort of decentralized system. And not that this is even closely related. Well, it is related, but it's like, if we scale this down, it was Guatemala, right? It was Guatemala was the first country to start accepting, or that allowed Bitcoin, or
oh no, that
was it
was
Guatemala?
El Salvador. No, that was
It was El Salvador. Excuse me.
Yeah.
How was that experiment gone, and what lessons can be learned from that? I mean, because I think that's at least a good test case at first to see how it could operate at a state level. I know it's not the exact same thing, but just when you have it at least as a state-sponsored kind of blockchain, if we extend that concept to the BRICS, which would be a state-sponsored, multiple state-sponsored blockchain, what lessons have we learned from El Salvador, if any?
Well, in my case, I'm getting a lot of mixed reports from them. A lot of people say that people at their base are not using Bitcoin, but you do see some reports that come out that say that people are using it and they're liking it. Excuse me. You have the country itself that continuously buys more, and they're saying that it's doing well. It's gone up since they bought it, so like they've added to their reserves instead of subtracting from them. So that's good. They wanted to get additional power plants up, and cheap power is, and if Bitcoin is what spurs them to building systems for cheap power, considering cheap power is what countries need to move forward, I'd say that that's a good thing. Regardless of any other effects that have happened in the short term, if that's what gets them to cheap power that allows them to get to the next level, then I'd say that that's a good thing. But overall, I can't say for sure what's going on either way, at least for now.
Huh. Yeah. Just coming back to the PayPal USD thing, because I was thinking about it for a second when you said it was 300 trillion, right? It was 300 trillion PayPal US dollars. And I think putting that into perspective for a second, what exactly is 300 trillion US dollars? And that is more than 14 times of the entire US money supply. That's 14 times the US M2. That is roughly 3 times the entire planet's. So whoever had this fat finger error created something that was so large, it was 3 times larger than all of the cash on the planet put together. Mm-hmm. And you could have bought every single public company on the planet had you been fast enough to get onto those PayPal users. That was the scope of that error. So I just found that, I looked that up very quickly after Gio said it was 300 trillion. I was like, oh, that's a lot of money. And wow. So I was just thinking about this, like enough money to buy every public company in the planet from an error, from probably one person's error.
Yeah.
So clearly risk management will be very important.
Yeah, it was not there on the day, I can tell you that. Oh, yeah.
Oh, Gio, did you freeze? Oh, sorry, you froze again, buddy. You want to start your question again?
Yeah, one thing I wanted to ask you, what about BRICS using euros or Swiss franc as, like, I guess, the reserve or backup currency instead of using like the US dollar or any other, I guess, native dollar, like, whatever, Russian rupees or Indian rupees?
Dave, I think that's a question for you, not for me.
It is. It's just he froze. So I was waiting. But yeah. Not to turn the whole podcast into an ad, but that's literally what we enable. Like you can enable that with a decentralized system. You can enable that without giving up power. And you can even. And with a modular system, you can add additional modules so that way people have control over their currency, and without having control over the other currencies. Things like that are possible. It's very, very easy to do. You give me all the rules, and I can basically make a system for you that'll work with those rules. As long as you know all the rules, it's easy. But it's just algorithms. My entire background in software engineering, it's all algorithms and data structures. Like, I can do it very, very easily. It's just when you have when you look at the problem the wrong way, then you're not going to come to the right solution. Looking at just to give an example, there's a problem that you can check out in software engineering called the 8 queens problem. So how do you put 8 queens
Sorry,
on the
can you repeat
chessboard?
that? What's it called? The 8
queens problem, like in chess. So you have a chessboard, you put 8 queens on there where none of them can take the others. How do you do that? Well, you can look at a chessboard as a 2D figure, and you can try to plan it out with that, and that's going to take a while. It's going to be very, very difficult. But if you put all the different rows on a chessboard side by side, then it becomes a counting problem. Now you're not trying to figure out where can I put this next queen so that way it doesn't take the others, and try to figure out, okay, well, now I have nowhere to put the last one, and let me start over. It's a counting problem now, because every single number for every place you use, some number of spaces afterwards is the first place that you can put the next queen, where it cannot take the previous queen or any queen before.
That's really cool. I never heard of this thing.
Yeah, so like how you look at the problem changes how easily you can come to the solution. And for a solution like this, a lot of people are coming at it from the wrong angle. That's why they're not able to come to the solution properly. That's why it takes them so many years to come to the solution. They're just looking at it from the wrong angle. Much like with the horse problem that I told you. A lot of people were looking at it as, oh, well, if you use this side, it's going to have more. Oh, well, if you use this side, it's going to be more accurate. It's like, no.
Instead of keeping up with the horse.
Yeah.
So like with this, yeah, they can use Swiss francs. They can use that. They can use other things. They had 3 original parameters, three rules to the system that they want to implement. 1, they are able to hold their own reserves. 2, that they are able to diversify their reserves. And 3, there is no blacklisting or seizure of those reserves. If they are to hold within another currency entirely, that stops that. If they're to hold another currency in part, then that part can still be seized. That part can still be blacklisted. So they have to be on a system that is decentralized. That they're basically describing blockchain, because with blockchain, as long as you do it right, as long as you make it decentralized, then their assets can't be seized, their assets can't be blacklisted, and as long as you make a system where it is very scalable, where it's very adaptable, then you can diversify those reserves while still keeping them self-custody. So yeah, you can do it with Swiss francs if you use it on an adaptive system, but if you do it in the current system, that's just going to violate one of those 3 rules, and they're going to be it's going to allow those assets to be seized.
Yeah.
So I think we're getting close to an hour, guys. So I think we should probably wrap it up. Here's a couple, let me do it like this, David. I'm going to do a little bit of a rapid fire. Okay. So imagine you're our audience here. We've been spending this entire hour talking about stablecoins. We've gone through some of the risks, some of the errors that have come up, the applications, the potential industries that can come down the road if we do start seeing mainstream adoption of every company on the planet by issuing their own stablecoins. Now, so these are designed to be, let's say, just quick questions.
Yeah, sorry.
That our audience, yeah, like 5 words, 6 words, just something that I want the audience to walk away from, like stuff that they did not know coming before listening to this podcast today, right? So if we just summarize it like this, if you had to say very quickly, what's the next thing that's about to happen for stablecoins? What do you think people need to pay attention to now?
Could you clarify, is that on the economic side or like potential risks?
I would say it's a little bit of both, but it's more like, we're going to start hearing more about it. Everyone's going to start hearing more about it. Most people don't know what they are and how it's going to affect their lives. So if you had to tell someone very quickly in an elevator how a stablecoin is likely going to affect their lives in the short run, what would you say?
I would make sure you trust the currency and the company that's backing it. Make sure that you, because I think that would probably cover it actually. Just make sure that you're trusting the company that's making the stablecoin and the currency that the stablecoin is pegged to, because either of those are going to be points of failure. So I think that would cover it. Just that. Okay. And what do you think? And this is a tough one. I love putting you on the spot, and then we can prove that none of this was staged beforehand. What do you think the next major breakthrough on stable coins is going to be that's going to keep pushing it to adoption? I'm going to say automatic routing. You fix the crypto UI problem, and then that fixes the crypto adoption problem because it puts it behind the scenes as opposed to people having to know every step of the tech to interact with it.
And this is what you're talking about before, the 5 steps. First, you do this, and then you can swap it, and then you got to bridge to a different network, and then you got to send it to a different wallet. That's what we're referring to here. Okay. Now, last one. Now, let's say you're Jamie Dimon. You're the patriarchy. You're one of the bigwigs that we were talking about before. What's your role in this? How do you try and get the future to come about, but at the same time not allow the existing infrastructure to completely be pushed aside? What do you do as Jamie Dimon?
Well, I would try to. I really hate that. I really hate that hypothetical because I think
sorry.
like when you make a system, you want to imagine yourself as the worst possible role within that system. So like if you have a system that's really good, you being at the worst rung within that system, you'll still be able to survive. You'll still be able to move up. Thinking from the top of the system, like oh no, all right, but with that, like if I wanted to try to make the system and if I wanted to try to put in stablecoins and keep the current system, then what I would try to do is have that be controlled by put in enough regulations that new companies can't come about. Because the problem that you have as the rich is the intelligent. Intelligent people are likely to move up, and if they are more intelligent than you, then once they get enough power, then they can take you out. So put in regulations so that way that stops them in their tracks. One, you have enough regulations that's going to stop them. Then they have to move over to a new industry, or they have to find some way to lawyer themselves into your industry. It's like, oh no, this isn't money, this is cryptocurrency, like that kind of thing. Now with once you have that, then you can start pushing larger companies to move into that space instead, much like Visa or MasterCard, because it doesn't matter what their underlying rails are, they're still in control of the system. They're already top dog. They're already working with the government. All you have to do is like if people want blockchain, now you can advertise them as blockchain. Great, good job. You have stablecoins. You want to move money between different systems with that. Great, you can move it between different systems. The problem that you're going to have, because like their company is still there. The problem that you're going to have though is that the G7 is not going to. The G7 has run out of moves. BRICS wins at this point. Like you can see this with China not being reactive anymore, but taking the offensive. So in all these previous cases, Trump pushed tariffs. China reacted to those tariffs with their own. Trump went and met, and then both tariffs came down. What's happening now is that China is the one starting. So either Trump goes over there and gives up something, which he's not going to want to do, or he's going to have to or he's just going to have to take it. Same with Europe. There was a country in Europe, I don't remember which, that seized something from China, seized one of China's assets. I think it was a port. Then China basically just shut off. China recently just shut off semiconductor exports, like rare earth mineral exports, and basically said to Europe, like, okay, your electric car industry, we're not dealing with that anymore. Yeah. So like Europe is like the G7 is finding out, oh, we don't have any cards to play. So like if you're in control of the current system, like, yeah, you can crack down on the people, and they are trying to do that, and they're going to continue trying to do that. Like for example, with universal ID, everyone thought that was conspiracy theory, and now look, it's oh yeah, they're actually doing that. Because what people said before was, oh yeah, you have this phone in your pocket, like they can just track you through that. Like, okay, well, like yeah, maybe. They're coming out with the universal ID now. They're coming out with the digital ID now. So they were still following through on their plan, even if we all have this. So oh well.
Yeah.
Now, if you're in control of the current system, if you're at the top of the chain, there's a new chain coming about. So I don't think that that's going to work out too well. But just the powers against the people, yeah, you can put in regulations. You can tie it to the largest companies, so that way you can continue to regulate them the same way that you have before. Because if you only have to regulate one country, if you only have to deal with one company, that's a lot easier than dealing with 100. And if you put in regulations to stop other companies from coming up, it's easy to squash. It's easy to squash any other smaller companies that you don't want to deal with. So you can just centralize everything. And the easier you move things to centralization, the easier you're going to have with power.
And then look, you know what? You said you weren't comfortable with the hypotheticals. That was actually an incredible answer. All right. So I thought that was actually a brilliant answer. All right. So Gio, I think we should wrap up this third. Is this our third edition already?
Yeah, this is our third episode right here. This is our third episode.
Well, I love it, David. You were a star. That those were some amazing answers you gave us there. That was absolutely incredible amount of knowledge you just gave everybody out there. Thank you.
Thanks.
Yeah, agreed. And if you continued, we probably could have made like a fourth episode right there.
Oh, I think so. I think we will be coming back to this at some point. I mean, it's because it just creates even more questions, and especially since we're trying to focus a little bit. Okay, what are the implications? What's the future? What should people know about this? As we've said this many times, we're working in an environment right now with pretty much whatever we know is obsolete 1 week later. So there's going to be so many different things coming up when you have very many smart people working in a concentrated area. All racing to make the next big breakthrough. I think we'll have a lot to talk about over this in time.
Definitely.
And then in the meantime, we'll get ready for episode 4 coming in 2 weeks.
Yeah, definitely. So I guess we can end it off here. And just, I guess everyone who's watching this can share the podcast. Let us know what you want to hear on episode 4, or if you want us to continue. I think we should continue on episode 4, honestly.
With what? With the stable coins?
With BRICS. Like, we can get a lot more into, I think we can get a lot more into it.
Yeah, there's been a lot of stuff with that.
All right, so we'll put a little teaser out there. More on BRICS to come.
Yeah, definitely.
Awesome. Well, thank you very much, guys. This is awesome as always. And like I said, you never know what happens when you put a group of people in the same industry that barely know each other together, and you see the magic that comes out of it.
Exactly.
All right. Thank you very much to everyone out there. We love you. And we'll see you in our next episode, 2 weeks.
Yep.